Monday, 16th March 2020, 9:35 p.m. West African time. Welcome to today's session, guys. This is Gene right here, and today's topic is how I predicted the March drop of 2020. So, what I'm actually going to be doing today is I'm going to be covering all the factors that are going to play in anticipating how the market basically dropped off March of 2020. So I would admit that this is one of my best calls, if not my best call, and it actually has been on the back of very solid calls, especially on the DXY. Looking back to September when we called eyes on DXY, all the way we anticipated lows forming around January and then highs forming around March. And the DXY played like it was a script, it played to perfection. And so far, it's been one of my best run on the DXY in the space of 6 months. But currently now, March was the best of them so far, as we're able to anticipate the market drop beforehand, and we're able to actually trade that drop. And I saw a lot of you guys sending me DMs on Instagram. Are you able to pay off mortgages? Are you able to pay off debt and all of that via trading that? Which makes me very, very happy, even though I was unable to post so many of your messages. But I felt pleased that I was at least seeing results from the free content I was giving out on the channel. And this even motivated me to share what I actually saw on via the market, studying the various aspects of the markets to call out to call the drop on the DXY, basically on all currencies. And so, just a warning: some things that I might talk about on today's session might be kind of foreign to some of you guys, but I'm going to try to do my best to ensure that everybody understands what I'm saying. Okay, everything is all clear, so you can actually apply some of the things I'm saying to your trading. So, with that being said, let's delve into the world of TradingView and barchart.com. All right, this is a simple chart of the DXY. Okay, and before I go into what I actually saw to call the drop on the DXY, I want to take you to the fundamentals. So the way I analyze my charts, I like to look at the higher time frames, looking at what the market is doing on the larger picture. This is what I feel most new traders actually fail to do. So if you look at most traders, especially those traders who come to my DMs saying they trade institutional, and then they fail to look at the monthly time frame, they fail to look at the weekly time frame, they fail to look at the daily time frame. You can't be an institutional trader if you don't have a general overview of where the market wants to go. So if you're only looking at the maximum of the daily and you're stuck on the 4 hour, 1 hour, 15-minute time frame, the big moves are always going to come as a surprise to you because you never know or you never expect when those big moves are going to come into play. So I'm going to give you an example. If you imagine a fish swimming at a pond, if a shark or a larger fish begins to approach that fish from afar off, you standing at the edge or at the bank of that pond can see that fish because you have a larger view of the bigger fish approaching the smaller fish. But to the smaller fish, everything all around it is all blue because it has a very limited vision, right? And then up comes the big fish and eats up the small fish. So the small fish was unable to escape because it had a limited view and was unable to see the big fish coming towards it to eat it. But you standing at the edge of the pond or at the bank, right, you can see the fish, the bigger fish or the larger fish approaching the smaller fish to eat it up. So this is the same way. This analogy can also be applied to you looking at smaller time frames and just being focused on the 1 hour, the 15 minute, the 30 minute, the 4 hour time frame, right? Because you fail to see what price is doing on a bigger scale. So the way I generally approach the market is to look at the larger picture to anticipate what actually is the larger move. So you want to identify institutional order flow. You want to know where institutional accumulation could most likely come into play. That way, you never miss the big moves. So with that being said, um, this I'm going to do a step-by-step breakdown on how I was able to basically anticipate the DXY dropping out by March, which came towards the end of February. About I think it was 3 days earlier than I expected, but all the same, we're 3 days short of our anticipation. But the market still played out, as you can see, March 1st, where we had huge drop on the DXY and basically on all foreign currencies. So before I go and explain what we're seeing currently on TradingView on the DXY, I just want to take your attention real quick to barchart.com. So now the reason why I do love barchart.com is that it shows you the futures contract of different asset classes. So the futures contract of commodities, future contract of currencies, of stocks, of indices. So barchart.com is actually a very good place to study the futures contract on a certain asset class. All right, so what you're seeing here actually is a chart of the 10-year Treasury note. All right, so this is a 10-year Treasury note, which you can see here, and the next tab on my Google Chrome is a futures contract of the DXY US dollar. It is a sorry, it actually is showing a 1 year range of the dollar. So basically showing the dollar over a 1 year period. So everything you're seeing from the left of the screen to the right of the screen is actually in a 1 year range. And what we're going to do is we're going to try to compare what the 10-year Treasury note was actually doing to the DXY. So before we delve into comparisons between the 10-year Treasury notes and the DXY, I want to explain the relationship between the 10-year Treasury notes and the DXY. So if the 10-year Treasury note is rallying, the DXY has to be dropping. So I'm going to explain real quick. So what I'm going to talk about now is purely fundamentals. So if you hear people saying fundamentals trading and all of that, fundamentals in trading is not actually looking at the news, watching for news forecasts, or anticipating news outcome. The news only is a result of what the smart money or the informed investors are doing. The news only happens as an outcome. For example, look at the coronavirus, right? So why is it that it is taking a virus not as deadly? This is not even one of the deadliest viruses we've had in human existence, right? So all the previous pandemics we've had the last decade is actually way more deadlier than this coronavirus. Yet it took this virus to crash a lot of the currencies in the world. So something as small as a virus is actually crashing the currencies in the world. So something fishy is actually going on here. Why is a virus crashing the world economy? When the SARS virus came, when the Ebola virus came, none of them affected the economy. But now the coronavirus, which actually has mortality rate only in elderly people with an history of respiratory tract diseases, this virus is actually causing the markets to drop. And look at the way the media hypes the virus. Every single person is talking about the virus, right? So something fishy is going on right here that is causing this market to drop. And I'm going to go into that real quick. So going back to the comparisons between 10-year Treasury notes and the US dollar. If the 10-year Treasury note is rallying, you want to see dollar dropping because the dollar is simply a reflection of interest rate yields. So higher interest rates yields leads to higher prices in currencies. Lower interest rate yield leads to lower currency prices. Okay, lower prices, sorry, in currencies. So make sure you write that down. High interest rate yields, higher currency prices, lower interest rate yield, lower currency prices because investment seeks yield. So in asset classes where there is yield, that is where investment will flock into. But now, in a situation where you're seeing the dollar dropping off, it means that there is lower yield in the currency market, which is reflected by the dollar. As you know, the dollar is the major currency of the world, kind of like the base currency of the world, which is what we see in the dollar. So the dollar is simply a reflection of the performance of the currency classes against other asset classes. So if yields are increasing, you want to see the dollar increasing. If yields are reducing, you want to see the dollar reducing. Okay, so now in a situation whereby you have yields reducing and the dollar is reducing, you're going to see a flock of investments away from the dollar since there is lower yields on the dollar into the treasury notes. This is where the correlation of higher treasury notes, lower dollar, higher dollar, lower treasury note comes into play. So investment is constantly fluctuating between either of the two. The reason why is because investors are constantly looking for asset classes that can yield them the most return on their investments. So in a situation whereby you have lower yield, money is going to move into treasury notes as indicated by the 10-year treasury notes. But now, in a case whereby you're having a 10-year treasury notes in a range, basically. So if you see the 10-year treasury notes in a range, and then the dollar is also in a range, that tells you something. Okay, that tells you something fishy is going on. So let's look at May 5th to July. Okay, so whilst the dollar was dropping off from May 5th, okay, the 10-year treasury notes was rallying until July, as it should be. This is where you want to see the pairs move. If one is going up, you want to see the other move down. So this was positive correlation between the US dollar and the 10-year treasury notes. Whilst 10-year treasury notes was trading higher, the dollar was trading lower, as you expect that to be. But now, around August, okay, there was bullish accumulation on a 10-year treasury note and explosive move to the upside. If you also look at the dollar, the same time period, bullish accumulation and explosive move to the upside. So now something fishy is going on. The dollar and 10-year treasury notes are not meant to move in the same direction. But now you're moving in the same direction. So that tells you that there's a stalemate of investment between the treasury notes and the dollar, indicated by yield or interest rates. Okay, so this basically means that you can anticipate a range in the market. This is why 3 months back, a lot of people were asking me, how was Gene able to predict that range in the market on US dollar? Basically, what I did was simply to look at the 10-year treasury notes and also look at the US dollar. They were moving in the same direction. They were moving in line with each other, which is not what you're supposed to see. So in a situation whereby you're seeing the dollar move one direction and you're also seeing the 10-year treasury notes move another direction, you're going to see a very large trading range in all currencies. So I want you to go and look at currencies from September until January. You're going to see very massive ranges on all these currencies. So the currency created very massive ranges. And I called this out 3 months back because this is what I saw on the 10-year treasury note and also the US dollar. But now, it is one thing to predict the range, right? This is another thing to predict the trend. So now, looking at the 10-year treasury notes, we can see that it was at the top of this trading range. So if you look at this upper horizontal line and the lower horizontal line, and also the reason why I was looking for higher prices on treasury notes and also the higher price on the dollar from around this level, because I called bullish dollar January 1st, 2020. And look at the way the dollar rallied. The reason why was because if this last down candle was what initiated all this bullish run, in line with this last down candle that initiated all this bullish run and all this trading range, if price comes back down to that candle, institutions who caused this move and also this same run on both the 10-year treasury notes and the dollar, they are going to defend their positions. they accumulated positions massively around this level. You're going to want to defend that position, which is why you want to see higher prices around that level. So this was the last range where institutional accumulation came into play on the 10-year treasury note. So basically, if you look at tight ranges before an explosive move, inside that tight range is where institutions actually did their trading. So just as a note to you guys, institutions trade in small ranges. The expansions you see in the market are simply a result of institutional action in small ranges. Okay, so now we actually saw the bullish move on the dollar like we anticipated, okay, to the highs of the trading range in line with the 10-year treasury note. Okay, 10-year treasury note also rallied to the top of its trading range. Now, this is where it all gets fishy. Okay, now you can expect both currencies to come back down and also continue to range. Okay, you can also expect the DXY to come back down and continue to range. But now, if you look at the video I highlighted on the free channel, okay, you're going to actually see I called bullish prices on the 10-year treasury notes from around this level, simply because this level was being defended by um, the institutions as the last buying point on the institutions. Okay, the last buying point of the institutions, and then there was nothing in form of open interest to suggest that the institutions were actually shorting around that level for us to expect or anticipate a bearish move. But compare that to the dollar, okay, whilst the dollar was rallying, once it got to this point, there was a massive drop in open interest. Massive drop in open interest before price dropped. Okay? And this was why I said once you see a bearish engulfing candle break down into that range, once price broke out, that is going to be the initiation of the massive sells. Okay, and if you also look at the 10-year treasury note, there was no bearish engulfing candle. Okay, so this is actually the 21st of February. Okay, and this is also the 21st of February this year. Okay, so now notice how there was a bearish engulfing candle back into the range on US dollar, but then on the 10-year treasury notes, there was a breakout and no bearish engulfing candle back into that range. So this bearish engulfing candle was a validation of a turtle soup setup, meaning a stop run to take out all the higher level short holders in the marketplace, taking them out before that drop. Okay, now if you couple that with seasonal tendencies, okay, which I'm going to show you real quick. So this is seasonal tendencies on the dollar. This is a 33-year seasonal tendency on the DXY. And if you look at the DXY seasonally during the end of February, DXY due to uh, I don't know why the scene actually went off. So okay, let me try to bring up that window real quick. All right, cool. So now, due to around the end of February going into March, you're going to see a massive rally on the DXY. Then around the opening of March, which is when you're going to see a massive drop on the DXY. Why does this keep closing? Okay. All right. So around March, which is when you're going to see a massive drop on the DXY. So this is actually a 33-year pattern of the DXY. The red dotted line is a 15-year pattern on DXY. The blue dotted line is a 5-year pattern on the DXY. Why does this keep closing? Okay, so let's do this real quick. All right, so look how the 3-year, the 15, and also the 5-year shows that around March, that is when the DXY is most likely to drop. Okay, so if you couple that with seasonal tendency, looking at past price action of the DXY over a course of 33 years and taking the average data, it shows you Towards the end of February, you're going to see massive rallies on DXY. Then around the 1st of March, you're going to start to see sells. This was why I was specific about the month. And I said sells on the DXY. Okay, I wanted to see sells on the DXY. And also, if you simply measure the speed of the move from this level to the top of this range, it is fairly equal to the speed of the move of from this level to the top of this range. So I think that sounds like way complex stuff. So let's just right here real quick. Okay, so if you measure this move from the bottom to the top of this range, it took about it um took about 48 days. Okay, 48 days on average, right? Now, if you look at similar move from the last bullish run in price to the top of this range, this was the top, initially the top. Okay, let me identify this level real quick. Okay, that was the equal eye price was reaching for. Also, relatively equal eye price was reaching for. So, if, okay, let's see. Cool. Right, cool. So if you look at price rallying from this level to the top of the initial high price was trying to reach for, if you look at the last candle, it actually came in a space of 36 days, right? Now, if you measure that with this candle trying to reach the top of its range, that is actually 40, 48 days. So you just have a difference of about, give or take, plus or minus 10 days. Okay, so you also couple that with seasonal tendencies, that starts to narrow down the time frame where you can expect sales to come into the marketplace. Now, I know this does not actually cover the crash, but when we saw this breakout on the 10-year treasury notes, there was nothing to reference in form of past price action. It's simply going back to 10-month period. Okay, once the 10-year treasury note broke out, there was nothing in the last 10 years in form of a bearish reference point to expect sales on the 10-year treasury note. Okay, and if we expect the 10-year treasury note to take out all those levels and just keep going higher, that is going to cause a massive drop on the DXY because you're oppositely correlated, because they just broke out of their ranges. Okay, so this is why I anticipated that massive drop on DXY. Now, going to stocks, the stock market. Okay, so now if you want to track smart money investments in the stock market, what you want to do is you want to look at the three major stock market indices. I'm talking about the S&P 500, the Nasdaq, and then the Dow Jones. Okay, normally if S&P 500 is moving one direction, you want to see all other two move the same direction. So if S&P 500 is making higher highs, higher lows, that should be reflected in the Nasdaq and the Dow Jones. But now in a situation whereby S&P 500 is trading higher, Nasdaq is trading higher, and the Dow is trading lower, that indicates something is going on. Insider trading. Money is actually being moved away from one of the indices. Okay, so now this is why I highlighted this with a trend line. Okay, so from around first the 8th of January 2020 to 31st of January 2020, right? S&P 500 was making higher lows, higher highs. If you also look at the Nasdaq, as expected, you want to see Nasdaq make higher highs, higher lows. Okay, in the same time period, Nasdaq Composite made higher lows, higher highs. Okay, low, higher low, as it should be. But now, if you look at the Dow Jones, okay, whilst both two were making higher highs and higher lows, the Dow Jones actually made equal lows and equal highs. Okay, pay attention. Higher highs, higher lows. Higher highs, higher lows. Now, equal highs, equal lows. That tells you something is wrong in the marketplace. Something is going on in the marketplace. That was why I called the stock market drop. It is about time for the bubble to explode. Now, all what I just did, yeah, and finally, let's also look at DXY. Okay, so real quick, if you look at the weekly time frame on DXY, um, the last thing in form of a premium level I was looking at for sales on DXY was this fair value gap that price. I wanted to see price completely fill before that drop, which is what price did. So basically, I wanted to see a quick drop to take out all the liquidity inside this range because there was massive liquidity. Retail was looking at these levels like, okay, let's keep buying, let's keep buying. Okay, so retail was going to have stop losses around this low, this low, this low. And look at how cleanly the market came and rated all those lows. Okay, market came cleanly to rate all those lows and traded into a monthly bullish discount array. Okay, so all those are all fundamentals in forex and technicals to back up why I called the stock market crash around March of 2020. And then one more thing I want you to also do is I know many of us actually do trade. Lots of us love to study what Gene sends out, study available resources on the internet, study lots of things. But what many of us actually fail to do is we actually fail to study what books put out by people who are actually successful. I'm talking about financial literacy book. So many of us are educated on how to trade the forex market, but how many of us are actually financially literate, meaning we know how to handle money, we know how to handle debt. Okay, so many of us actually do not know how to do all this, and we are very minute information about the way the economy of the world works. Okay, so if you know around 1971, Richard Nixon actually took the dollar or currencies of the gold standard, meaning currencies were no longer backed by gold. So now currencies were no longer backed by gold, meaning the banks could print as much money as they could. Banks will keep bailing out smaller banks and printing out much more money. The Federal Reserve, there was no more limit on the Federal Reserve. So the Federal Reserve could print as much money as it could. Now, I don't just there's this confusion from especially people in the US who think the Federal Reserve is actually a part of the United States government. The Federal Reserve is a private entity. It is self-regulating, regulates itself, it answers to nobody, and it was actually created in 1913. So the Federal Reserve is the biggest scam in U.S. history. It is the biggest scam in U.S. history because what actually happened was there was a war. The U.S. was unable to pay for the war. The U.S. actually got into debt with one of the Rothschilds family members. So this was all a ploy to get the U.S. into the pocketbooks of the elites. So the U.S. was the last stronghold for the elites. Okay, so we call them the robber barons of the 16th, 17th century with their plan to actually dominate the world. So I know we're getting into more conspiracy stuff, but I just want you guys to listen with an open mind. Because most of this is why you see me post on my social media that do not listen to what any mainstream news media tells you. Look at the panic the mainstream media caused with the coronavirus, right? It caused the stock market to crash. And I told you it was going to be, if you actually followed my Instagram, I told you it was going to be something in form of massive hysteria to cause the market, to validate the market's crash. Okay, September to October 2019 last year, Bill Gates sold his largest stocks ever. Uh, Tim Cook of Apple sold his largest Apple stock ever. Warren Buffett sold largest stocks ever. So many of these billionaires were selling the biggest stocks they've ever sold, all in the space of a month. So the next question you need to ask yourself is, why are all these people in positions of influence selling all the stocks off? And then you then see a month later, so many of the CEOs of the top companies in the world were stepping down. So why were these guys stepping down? Why were they selling their shares or their stocks off? Because they knew beforehand what was coming. All the economies of the world were all running on lifeguard. Okay, money was artificially being pumped to sustain the economy. Since 1971, when the currencies were taken off the gold standard, money had no more value. Eventually, the market or the economies are going to keep resetting in the form of a recession, just like the 2008 stock market crash. This is what is going to keep happening to reset the currencies because the currencies have no real value. Money is worthless. Money has no value. Your $100 bill has no value. Your £20 note has no value. So I see a lot of you guys who post on Instagram with bundles of money to your ears and all that, flexing and all that, right? All those things you're flexing has no value. Let me give you an example, right? So in the German Depression, the Great German Depression of the 1930s to 1940s, right, during the war, a woman actually wanted to get two loaves of bread. And due to the massive inflation caused by Hitler to fund the war against the other countries, right? The woman basically filled up a wheelbarrow with bundles of money to go to the store to get goods or things to buy. Okay? And then for her to be able to purchase the bread, she needed to take the bundles into the store bit by bit. So she had to cut off one third of the bundle of the money in the wheelbarrow, then another third, then the last third to complete the payment for the bread. That was how the inflation was serious in Germany, right? And then she went the first time to, deposit the money with the seller to get the bread. By the time she came outside, the wheelbarrow was stolen. The money was left on the floor. Why? Because money became worthless to people. Everybody had enough money to go around. What was actually lacking was real resources, wheelbarrow, food, water, the basic stuff. Right. So money actually is a form of IOU from the bank. So initially, before money was removed from the gold standard, 1971, right? Money was actually backed by gold. So for every dollar the bank lent out, right, there was an equivalent amount of that dollar in the vault of the bank in gold, in ounces of gold. So the banks could not actually overprint your money because gold was actually limited in supply. But now in 1971, when Richard Nixon came and then took off the dollar of the gold standard, everybody could print money. The Federal Reserve could print as much money as it could because nothing was backing the dollar. There was nothing to peg the value of the dollar to. So the dollar became a value of its own. And it's actually worthless because it's paper money. It's IOUs from the bank. So this is why you're seeing the massive debt crisis in the US, in Europe, in all currencies, all countries of the world, because every country in the world is running based off false false strength in the economy, false strength in the form of currencies that have no real value. The currencies, the money has no real value. So if you're seeing a stock market crash over the next couple months, that is simply the economy resetting itself because everything currently is way overpriced. Okay, and that is the natural state of things. Nothing keeps going up forever. Anything that goes up must surely come down. So this is an expected thing. This is actually even a good thing. If you see a recession or you see a stock market crash, it is a good thing because that now presents an opportunity for you to begin to invest into assets at cheaper prices. This is one of the ways to reach keeps getting richer. So I don't want this video to take too long, so I'm going to cut it off at this point. What I would do is I would recommend you to read the book Increase Your Financial IQ by Robert T. Kiyosaki. Okay, from Rich Dad series, Increase Your Financial IQ by Robert T. Kiyosaki. and he talks about everything wrong with the US, how the tax system is a fraud, what brought about the tax system, how you can get control of your money. And even in the book, okay, as a bonus, even in the book, he called the book was actually released 2010. Okay, he called a stock market crash towards the end of 2019 inside that book. So that book is a very good read. If you actually want to take your finances to the next level, you need to get financially literate. And that is by reading this book as a start. And that is actually going to help you, give you a lot of insight into the fundamentals, especially of the US economy, and why the US economy was running on basically, fuel that was not expected to last very long, which is what we're seeing right now. The market's dropping off. So let's see what the next few months present, especially with this hype from the coronavirus. Let's see if the markets are able to regain ground, or just this is actually just a mini correction, or this is actually the beginning of a major drop in the stocks, currencies, the commodities. With that being said, this is Gene right here. Thank you all for being a part of this call. Hopefully, this was insightful to all of you guys. And I'll see you next time. Goodbye.